What's my edge in oil trading? Conviction. With Sparta Curves, I get real-time, trusted prices from 30-plus top brokers. Futures, swaps, physical, and freight, all in one place. Switching from Bloomberg or Refinitiv only takes 15 minutes. Zero disruption. Now, our whole team runs on one flow. Sparta Curves, 45 days, free. No risk, no friction, just conviction. Start your free 45-day trial by visiting spartacommodities.com/curves.
Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com. Now over to your host, Sparta co-founder and CEO, Felipe Elink Sherman.
Welcome, everybody. Episode 41 of Sparta Market Outlook, the number one podcast in commodity trading, or according to internal sources. Anyway.
Why stop there? Don't stop there. It's the number one podcast in the whole world.
In the whole world, absolutely. No, I would say, the number one in commodity trading. I would say that's more of a fact. It's good to see you guys. I'm Felipe Elink Sherman, your host today. Talk about oil trading opportunities and what has happened in the market, etc. We have Neil Crosby. Hi, Neil. How are you today?
Good, thank you.
We also have June from Singapore. Hi, June. Morning.
Hi, everyone.
And Michael Ryan. Hi, Michael. How are you?
I'm good, thanks. Hi, guys.
So, let's start with macro, because the news flow has been relentless. Neil, maybe you want to start by giving us a summary of the thousands of information and news that have bombarded us in the market these days.
Yeah, I just thought it was a particularly noteworthy week in terms of competing headlines, let's say. So, of course, earlier in the week, there was the leaked information that Israel is planning to attack Iran. That was worth a bump on flat price. And then the last 24 hours, we got basically things like the Chevron waiver, which may or may not be extended. So it was supposed to be getting extended in Venezuela. And then Marco Rubio came out and said, no, that's not happening. And then there's a bunch of stuff on the EU planning to reduce the Russian price cap. There's potential peace negotiations in the Ukraine. It's all a bit much. I guess the more concrete thing that happened this week was definitely there's more of a risk-off mood in macro the last couple of days. So a bit more concern about, now there's more concern about US debt again, and definitely more concerns about stagflation, if you like. And that's also taking a hit in terms of the S&P 500 and to a certain extent probably also oil over the last hours. So yeah, very choppy waters, I would say, from the headlines perspective.
Yeah, actually, it's interesting when you talk to bankers here in Geneva or hedge fund managers, etc. Some of my friends, you see this dual perspective of the market. One of them, let's say the bond market. So bond traders are quite bearish, hawkish on the situation right now, and they're puzzled with this, craziness or bonanza that you find in the equity market. But on the equity market, you have the AI story, which we don't talk about it that much. But frankly speaking, when you see the progress and the advancement in all of these toolings and robotics and the way it's actually going to shape our future, it's quite impressive. So you have these two worlds that are colliding, and it seems like this is going to be a tendency until one of those two wins, if you want. Is it going to be, the over-indebted world and a sort of wake-up call, or AI is actually going to pull us out of that indebtedness and allow us to continue growing? But that seems to be a bit the summary of what I'm hearing when I talk to non-oil traders.
Yeah, and also I think you, on the shorter timescale, you mentioned it last week, you wouldn't want to be long on the basis that the Trump-China situation has been resolved. And I think that also played out this week as well, a bit less conviction that actually this trade relationship will calm down, let's say. I think that happened pretty much as you said it last week.
And you also had you had the Jody release giving us a bit more confirmation on, I would say, crude and products, but you want to summarize that as well?
Yeah, I wanted to maybe put this into two parts, and one of them is because I definitely saw this week a lot more articles about a rapid rise in global oil inventories. which is, of course, of interest, right? And I was just trying to pick out what is actually in these articles, because I'm seeing something slightly different just with the data that we track. So Jody released for March. I thought it was actually quite bullish for products again. For example, diesel middle distillate stocks were drawn down sharply, like more sharp than seasonality would suggest in Europe. And we're heading towards the 2023 level, which is quite low. And you can see exactly the same thing in the US right now in the weekly data. So products are tight at the front. The bigger problem was basically in crude, where there was a few more builds in Asia, but it's partly runs related, right? The crude runs, I think, were quite low in the OECD in March. So I think you should take that with a pinch of salt as well. And basically, when I look at total oil stocks in the OECD, like the year-to-date builds, it's quite a divergent picture between crude and products. So crude in March was a little bit loose, but products were tight. And the overall oil picture, I think, is no different to last year. In fact, it looks slightly tighter in terms of builds. So we're still in the same picture as we talked about the last months. And then let's talk about the articles that have been coming out. Basically, what they're talking about is things like a rise in inventory in China. So then we have to get into discussions about what does price actually trade off. You know, a lot of people would say it's OECD inventory. If you get China building SPR crude, that's a different kind of situation to a real, let's say, commercial inventory build elsewhere in the world, right? And it smacks of the kind of Chinese put story where if oil prices go down, basically they start building more for SPR. And I think that's partly what's driving these stories, right? And there's also a bit of oil on water. So oil on water is up. And that's definitely a thing that is a tricky data set, because that can get revised massively, and oil and water can also go, can spike over a few weeks for a variety of reasons. So I would say take these articles with a bit of caution, and I don't think we're at the point yet where we have to say, oh look, oil stocks are the tradable commercial oil stocks are building very rapidly for the time being. And then of course, remember, we're going into the time of year where demand rises, where crude runs go to max and margins are good, so things tend to draw from here. So I think I just wanted to say a bit of cautionary note about that just now.
It's interesting you mentioned that, because I think Muscari sending this report, I don't know, one of the banks essentially talking about oil inventory this morning. And you look at these charts, the classic seasonal charts, comparing this year relative to other years, etc. And then the projection from this bank. And it was like every single one of those charts was, in terms of stocks, it was, we were within the range of the last, I would say, 3, 4, 5 years. And then immediately it was like the projection was skyrocketing up and to the right, as in, okay, we are breaking out from any kind of historical level and we're in a new paradigm, if you want. Because when you see that chart, your first reaction is, okay, whatever I knew is no longer valid. And now the stocks are going to be double that, what we had over the last 5 years, seasonally. It's a big statement. I mean, that's a massive statement that it's difficult to justify. And then the danger is that you get into a situation where you start shorting or you become very bearish and at a level which is already quite low, So I struggle to, and then one question I had for you. You mentioned here that, Jody sort of published these stats, and again, they're outdated, they're from March or something like that. So when you say that the market, that therefore the products are bullish, as an analyst, what do you think the market has done? Have they, the rest of the analysts, did they have those numbers and this is just a confirmation? So when you look at your supply and demand balances for May, for today, not for March, when you get the Jody, is that a confirmation that your numbers are correct, you think, overall? Or is everyone saying, oh, my numbers in May my stocks were too high, I need to bring them down? And everyone is correcting now.
Yeah, so I mean, there's a number of situations. It depends how good a job you think you've done of the nowcast, so to speak. But to a certain extent, the Jody numbers are confirmation of certain numbers that you already have.
I know. Conceptually, I understand. But what do you think is happening right now overall? Is everyone reducing their stock levels, or is everyone sort of confirming what they already had in their spreadsheets?
Well, if you look at price, I think it's just a confirmation that the situation hasn't changed all that much, right? I mean, diesel spreads are still backward, cracks are looking okay, EBOB spreads are a bit weak seasonally, I would say, but overall margins are good. I don't see a big change in the price setup. So it's not like a bunch of analysts have expected on their spreadsheets a big ballooning of product stocks, for example. I suspect it's, for the savvy analyst, it's kind of more the same. Like, okay, I don't see a reason to really change my view on the very prompt market, let's say, in terms of product stocks.
So why is everyone sort of predicting this paradigm shift? What is the story there?
Well, hark back to what you just said in terms of those charts from the bank analysis, right? All of this is predicated on future stories about supply and demand, right? Because if you recall, like over the last month, everybody's chopped their demand growth forecasts in half or more. And in the same report, you can see that a bunch of these high frequency indicators like port container throughput, but it's above normal, it's above last year still. Freight traffic, trucking indices, they all look fine. It's only like a very specific, let's say, China-US trade situation, which is a problem. But all of these high-frequency indicators don't suggest that demand has come off. So all this chat about rising stocks is predicated on much weaker demand, and we haven't seen that happen yet. And the other side of the coin is a lot is also predicated on a big rise in OPEC supply, actual OPEC supply to market. And I think we've talked about this in the last couple of pods. That might not necessarily be true, because it's rather, the official target has gone up, but now we're sort of narrowing the gap between what they already have been exporting and what they say they're supplying.
Fair enough. So look, something to keep an eye on, but it's a recurring piece over this year where everyone is sort of anticipating. Again, when you see those charts, I have to insist, it's not like a 10%, some little increase. It's like we're completely moving away from anything we had over the last years, so, and it seems to me that we're, of course, not in a bullish momentum, flat prices indicating that. But once again, when you look at the price story, it's telling you something very different, that these sort of anticipation of the particularly spreads, it's not telling you the same story. And we just keep kicking the can down the road. And it seems like this sort of bearish momentum or storytelling, it's like, oh, it's not this quarter. It's going to be next quarter. It's going to be next quarter, and I'm not talking flat price, but I'm talking all the other indicators are not showing that same story, I would say. So it's something to keep an eye on.
I'm totally open to it happening, but I just wouldn't predicate it on oil and water data and Chinese SPR build, right? Because I would need something else.
Good point. The other story is Indonesia. June, maybe you want to summarize that and we can go into the details of what it means and what's going to be the impact.
Yep, sure. 2 weeks ago, we heard that the Indonesia's energy minister announced that Indonesia will gradually eliminate oil imports from Singapore and take cargoes from Middle East and the US instead, in the name of balance on geopolitics. The impacted grades should be gasoline, diesel, and jet, but the biggest impact will be on the Sing 92 market. And then earlier this week, what we saw was there was 5 tenders issued by Pertamina for 1.6 million barrels of raw 90 and 1.2 million barrels of raw 92 grade, a month for delivery between July and December this year, and specifically excluding Singapore as the origin of supply in 2 of these 5 tenders. The tender closed on 20th of May and is valid until the 30th of May.
So just to put things into perspective, what is the reason why? Is there sort of like geopolitical issue between Indonesia and Singapore? The reason I'm asking is this
not between the two nations,
Sorry?
It's more I think it's not that relationships between Singapore and Indonesia is bad. There is a cloud of corruption charges against the Pertamina officials who, as we know, mainly imports from Singapore, all these grades. And therefore, there's a spotlight that why can't we source from oil-rich countries? Why do we need to source from Singapore, which has no resource at all, and have that dependency on this small state? And the other side, you have the US tariffs negotiation ongoing. So Indonesia is trying to use oil imports as a leverage. But I think there's a quality mismatch, right? Because US, we know, is actually net long crude, less so gasoline, which Indonesia is short of.
Very clear. Okay, so that's the why we got into this. Just to put a little bit of perspective, you talked about this tender. What is the percentage or what is the volumes that go from Singapore to, let's talk gasoline. I think the biggest impact is on gasoline. What is the volume that goes from Singapore to Indonesia? And what is the percentage of that relative to all of the imports? Give you a little bit of perspective here.
We are looking at about 2 million barrels per month of gasoline imports average over the year. Of course, there's seasonality. Currently, more than 80% of these imports are coming from Singapore. A common misconception is this all coming from Singapore refineries. That's not really true. Most of it is actually from blenders who brings in imported components around the region like MTBE, naphtha, and finished grades from other Asian countries to make cheapest blend for Indo 90 and 92.
Yeah. And do we have any econs insights on the ARB picture? Will it make sense to bring from AG, from Houston, in order to replace Singapore barrels? Because that's sort of the story, it's like, well, let's buy it from oil-rich countries and therefore sort of confusing crude oil with gasoline, but in a way, is that even possible? Or do you see it's feasible?
We try to be scientific here. We use our Sparta's gasoline blender and we look at a July delivery window, comparing the three cost of delivery, Singapore MR versus AG LR1 cargo. That's about $2 to $3 per barrel more expensive to bring the AG barrel to Indonesia. And for the Houston LR1, that's $7 to $8 per barrel economic disincentive. That's also excluding any additional breakbulk costs associated with the LR1.
So no, clearly, and there's a reason why it's imported locally or from Singapore, but this is a first pass. It's $2 or $3 or $7, $8 a barrel more expensive to bring from these oil-rich countries that they were mentioning. So but we'll go into that in a second. But generally speaking, the long-haul ARBs they're usually about freight efficiency. Do you think that Indonesia has invested in the right infrastructure to make this elimination of oil imports from Singapore?
We are calculating roughly about 16 out of the 60 oil terminals in Indonesia that can take at least an LR1. That's the general vessel type for long-haul arbitrage to work. And even today, we're already seeing about 25% of total imports into Indonesia already on the LR1 basis. So thinking that to replace the whole volume entirely from Singapore, we need to see significant investments on these terminals to allow direct LR1 berthing or provide more efficient breakbulk capabilities. And from tankage point of view, at least in Singapore, many of these tanks are already catered solely for MoGas blending into Indonesia. And the question we are having is, what will happen to all these tanks if Singapore is not now the source of oil supply into Indonesia?
Yeah. No, so we'll go into the market call and what does this mean. But before, I'd like to go into the freight section of things, So how does what is the immediate thoughts, or what is the freight market saying about this, Michael?
Yeah, so my view is it's mildly bullish ton mile, just because instead of doing these very short milk runs from Singapore down into the Indonesia terminals, your new options are AG into Indo or US into Indo, and these are drastically longer voyage times. So your ton mile usage percentage will go up. Now, realistically, do we see a lot of cargoes move from the US into Indo in the near term? Probably not, but we should see an increase coming out of the AG. And if you were to look at the TC5 rates, so your LR1 FFA and your TC17 rates, which is your MR FFA, both out of the AG, they have been rallying since the beginning of May. And at first, that didn't have anything to do with Indonesia. It was driven by open naphtha ARBs pulling barrels into the east and open jet ARBs pulling barrels west into Europe. But over the last 10 days or so, as those ARBs have shut, in part due to the rally in freight rates, it looks like some of the support has stayed because of this Indonesia news. So in my opinion, the real winner will be MRs out of the AG. As June said, there's not a lot of capability to take LR1s into the current docks and terminals in Indonesia, but MRs will work. So I think we could see a higher baseline set of rates coming out of the AG. So even though those jet ARBs, basis MR econs pointing into Europe, are now shut, we should see a higher baseline rate out of the AG now for your MR market.
Oh, yeah, but that's assuming that the volumes do come from the AG. Now,
yes.
And in a direct basis, because once again, look, I have a slightly different view in the sense that, first of all, it's not, as June was pointing out, it's not gasoline produced in Singapore. It is gasoline that was blended in Singapore, because that's the vast majority of it is Singapore blended. Now, in order for you to have a stamp, saying this is gasoline from Singapore, so country of origin Singapore, you either need to have a significant transformation or having different codes, So if you have MTBE, that is a chemical product and has a chemical code, tax code or whatever, and you convert that into gasoline, you need to blend it, and then now it's called gasoline, and that's different. You can then claim that that is Singaporean. But if you are buying gasoline from China and you put it in tank in Singapore and then you sell that to Indonesia, that can still be Chinese product, you see. It's not Singaporean. So first of all, what my thinking, and we've seen this in the market, when the news appeared, boom, the first thing was spreads came off, East-West came off, and then it's been bouncing back since, I would say, a couple of days. My point here is that, first of all, people are going to find loopholes. That's the first thing traders do. That's what they're good at for the last, thousands of years. They've been very good at finding loopholes. So first loophole is, the big winner here is Malaysian tanks instead of Singapore tanks. So if you have tanks in Malaysia, and I can think of a couple of companies, they're golden because they can continue doing their operation and ship whatever they can to. So first of all, it's going to be a shift between, let's say that you had the tender and there, 10 companies with 5 in Singapore, in tanks in Singapore, 5 in Malaysia. Now, those guys in Malaysia are going to win all the tender. Why? Because the alternative from AG or from the US is just way too expensive. So it's going to be the same game, but you're reducing your supply pool. So that's shooting yourself in the foot because, as you said, the next alternative, which is what they had in mind when they did this, is way too expensive relative to the second best option, which is to simply blend in Malaysia. That's the first thing. The second thing is, instead of blending and optimizing your blend, you're going to be under-optimizing your blend, but making sure that it's never sort of Singaporean. So you keep on country of origin, etc., because that's still going to be cheaper than importing directly from, in this case, AG. So in the short term, particularly in summer, because obviously in summer, East-West is much lower, so importing from Gulf Coast is out of the question. We'll see in winter when the East-West now becomes positive. Perhaps that's an opportunity. But frankly speaking, in the short term, for me, it's pretty much the same thing, but we're going to see a little bit of gimmicks here and there, some loophole finding, but the oil ultimately is still going to be coming from the north, so the Far East, so Japan, Korea, China, etc. That's main flow is going to come from there. You're still going to have a little bit of flow from India and perhaps AG. But for me, this is not changing that much. What it's really doing is the tankage. Your tankage in Singapore is going to be worth less, and your tankage in Malaysia is going to be worth more. That being said, there is one element here that is important, is the window. When you are trading the window, Indonesia represents a big percentage of that bid level, so people buying in the window to supply Indonesia. Now that's going to put a lid to that. You're not going to be able to support the market by bidding the window because you're not going to have the ammunition. You're not going to have that short that you can dispose of now. Or you could, but then you need to go to Malaysia. Well, there's additional costs. So what I'm trying to say is that fundamentally, I don't think it's going to change that much. It's just going to be, there's going to be some big winners and some losers in terms of individual companies, depending on their logistical situation. But overall, and if you're putting a lid to any kind of bullishness on the window, other than that, for me, it's the same thing. That's my point of view right now.
Does Malaysia have the capacity and the logistical capability to step in?
No, not really. I don't think so. But again, that's why I was saying, Malaysia is going to be the big winner. And then you're going to have the others that are not going to optimize their blend in order to maintain a sort of like non-Singaporean origin in their. Again, there are rules like, for example, the significant, in order to have a label, Singapore origin, you need to have that significant transformation. And it can be also a price increase or a chemical change, etc. So what I'm saying is that people are going to be looking at that as a first way of solving. But let's see. Look, maybe I'm completely wrong. And on the I would be very keen to see what is the result from the tender, see what are the companies that are winning, and then start tracking where the oil is coming from. I would say this, next alternative is AG, indeed, yes.
But we've been seeing more fixtures coming out of the Far East heading towards Indonesia over the last 10 days or so. And as a result, TC11, which is Far East down into Indo, that has moved from, it's up 40 world scale points as well. So that is impacted just as much out of it compared to the AG.
Yeah, but I mean, that oil was flowing there anyway. I mean,
Maybe
what?
It's a rush to fix.
It's to fix, and that's the word. Maybe the rush is because you want to have a higher percentage of Chinese barrels in your blend so that you can reclaim as Chinese, So again, I don't know the rules. I knew the rules at the time in Europe of it has to be a certain percent. Maybe their tanks is full Singapore because they already custom cleared it and became Singaporean. and now you blend it with the same quality but Chinese or Korean or whatever, and you have a 55-45 blend, now it's all Chinese or Korean, you see? Maybe that is the rush. But those barrels were going to be flowing there anyway, or maybe they would have gone to the US or Mexico, etc. But now they're coming in just for a tactical kind of situation.
Yeah, maybe they're diverting from West Coast South America to Singapore or something for this period.
But again, it's a short-term thing. And once you've changed your logistical game, then that's it. That's okay. Now all my tanks are non-Singaporean, and I will only convert them to Singaporean when I need to.
Yeah.
Again, this tells you how geopolitics has such an impact in this market, and the fact that they're like, we need to buy from oil-producing countries instead of Singapore, when that just basically tells you that they don't know the difference between crude and gasoline. But anyway, that's another day. June, staying with you here. Physical crude. What do you want to tell us about physical? That's my prompt. Ask June about physical crude. That's very wide.
Okay, so let's just update what's happening in the crude markets. We are seeing light sweet premiums globally weaken relative to the sour market, which has strengthened over Q2. But Brent Dubai has become very wide nonetheless, with Dubai spreads lagging. So in the east, what it means is most of the ARBs are shut. WTI is out of the money, about $1 per barrel off versus Melbourne. CPC ARB was mostly closed. Just only about 2 days ago, we start to see the CPC premium falling off, and that ARB has now started to open again. So majority of the time, we are seeing Melbourne and DARS acting as the marginal crude swing here. Melbourne was the weakest grade among the Dubai crude basket in the Platts window, which traded about 10 cents discount to Upper Zakum and Oman. However, in the last 2 days, we start to see it slightly back into premium again. With the strong refining margins that we continue to see, mainly due to a strong fuel oil cracks, refineries would look to preferentially fill up their base load with all these heavier grades, and you run these light sour crudes on simple margin or incremental margin basis if there's any more capacity left. And we see that, for example, Basra Heavy trading at high premiums to OSP, which makes sense when you look at Basra Heavy versus Coal Lake or TMX. Watch out though with Alberton oil sands maintenance over and Mars diff plummeting, so that might change a bit.
And how's the AJ physical trading window currently?
We are now doing second half July and early August arrivals for the AG. It's a bit weaker than our expectation this month, given that all the refineries in the east are back from turnarounds. But the Western market has been stronger, and that kind of contributed to shutting of the ARBs, except for CPC. In the July Brent Dubai EFS, there's now widened to about $1.60, $1.70 per barrel levels, which is about $1 per barrel higher than it was last month. Whilst the cash diffs for these AG barrels are fairly within range of last month. So overall, ARBs are really kept shut out of the region. Physical market spot activity is quite active. We saw Indians and the Thais coming out for tenders, which can be supplied by both Melbourne or WAF crudes. And PTT reportedly bought a bunch of Melbourne and Umlulu in this tender, backing out WAF. Heavier barrels are trading at premiums. It's a very different market to the light sours. And interestingly for Umlulu, it is at a discount to Melbourne. And I highlight this because Umlulu is lower sulfur than Melbourne. So you do not typically expect a lower sulfur grade to get a discount to another benchmark crude. So I have to crown Melbourne as the marginal crude of the East right now. And that position was actually WTI not so long ago.
It's interesting. I just wanted to pick up on why is this happening? So we've talked about the fact that light sweets are looking a bit weaker generally than the sour market. So try and figure out why Melbourne is the cheapest crude by far. Is it OPEC supply is rising, or is it, I'm looking at things like Cushing stocks. Cushing stocks are rapidly approaching quite a low level again. So to a certain extent, it seems to me like it's justified by tightening US stocks and high runs in the US, right? It's kind of like TI is also trying to price itself out a bit from Asia. That's my impression. I don't know if you see it the same way, June.
Yeah, I agree with that. I initially, we also thought it's the rest of the US heavies needing to stay in the US with the Venezuelan barrels coming out. So you probably need to price WTI as a marker stronger as well. Yeah, but we'll see whether that sanction waiver will take place or not.
Yeah.
Okay, so I think we have another week to go to the physical trading window here. I believe that the Melbourne diffs can still come off a little bit more to stoke incremental demand to sweep up the rest of the barrels and overcome the simple margins in order for Melbourne to get into any more capacity within the refineries here in the east.
Michael, do you want to link this to DPP freights in case, what are your thoughts on this relative to what June is saying on the crude market?
Yeah, I just wanted to share briefly. So in Sparta, we've been working on something we're calling the RBI, which is the Relative Basket Index. And what that is, if we choose a single refinery zone, if we take Northwest Europe basis, the Atlantic Basin, what we're doing is we're taking TD20, so your WAF Suezmaxes, and comparing how that route and that grade delivers into Northwest Europe versus all of its competition. So think your US Gulf Coast grades like LLS and WTI on an Aframax out of the US Gulf Coast, your LATAM grades, your AG grades, your short haul out of Northwest Europe as well. And what we're seeing now is after TD20 was severely overvalued going into the middle of May, prices have corrected, and now it's basically in line with the competition across the board for the other grades delivering into that refinery zone. And we've done the same thing for TD25, TD3, and TD22. And TD3 and TD22 are basically both neutral versus all of their competition, whereas TD25 is now looking more and more bullish. It's approaching severely undervalued territory. And what that means is it's starting to become more attractive to fix an Aframax carrying crude than fixing a similar vessel out of, say, LATAM, WAF, or the AG to deliver into Northwest Europe. And I just wanted to share that because it's somewhat of a new way to look at DPP freight.
This is super interesting. Remind me, TD25 is which route?
It's USGC Aframaxes into Northwest Europe.
So essentially, explain more about how do you get to this calculation, if you don't mind, because I'm pretty interested.
So what we're doing is we're leveraging the crude ARBs in the Sparta platform, and we're taking those landed values. And for each of these routes, so again, TD25 delivering into Northwest Europe, same for TD20, but a different vessel class. Then your TD3 and your TD22 are delivering into the Far East, but out of the AG and out of the US Gulf Coast. So for example, TD25, your Aframaxes into Northwest Europe, we are then taking similar vessel classes, so mostly Aframaxes, maybe a couple Suezmaxes from the main material competing regions, loading your crude grades out of LATAM, WAF, and the AG, and saying, okay, your crude grades out of the US Gulf Coast, how are they landing in comparison? And that's basis the econs of the actual crude and the TD25 route and the routes from the other locations. And for example, right now, TD25 is becoming more and more undervalued, i.e. the econs are looking better to buy your crude out of the US Gulf Coast on an Afra to deliver into Northwest Europe compared to all the other competition. And what this means is we should see an uptick soon in the demand for Afras out of the US Gulf Coast relative to your Suezmaxes out of WAF, so forth and so on.
That also works with, just to chime in here, I'm sorry, Felipe, if you're going to ask something, but it kind of also works with what the TI RB cons are looking like. So for much of May, 40s looked exceedingly cheap. Europe and the sort of US exports data looks pretty low, like the last 2 weeks, which is relevant to the first half of May. But now things are much more neutral. So from an ARB perspective, it looks like TI should start to, or marginal TI barrels should start to flow again relatively soon.
And this makes sense because we're using a combination of those landed values and the relevant freight routes. So in the first half of May, TD25 was severely overvalued as well, and it's just been in the last week to 10 days or so where that moved to neutral and is now digging itself a hole to come back.
And are you capable of separating what is, because when you look at an ARB, there's a component of cash diff, there's a component of the freight, there's a component of the sales price, market structure, and all that. So when you're talking about TD25, are you talking about the freight element of T10, just the pure freight, or are you talking about the route, meaning including cash diffs, and the ARB, if you want?
So in the calculation for comparing to the relative basket for the index, we're using everything that you just spoke about, the full, all the components of the landed value ARB. But what we've turned it into is something actionable for the freight market. So we're basically translating into what it means for freight. And what it's saying is freight itself is now undervalued. And it's more attractive for the buyers out of Northwest Europe to buy crude from the US Gulf Coast. Therefore, we should see Afra's increase in demand.
Okay.
So we're really turning it from a crude trader perspective now into that DPP freight trader or charterer perspective.
Yeah, because it's also telling me that the cash diffs on a relative basis are cheap, so maybe, correct me if I'm wrong, but maybe the problem is solved, or the undervalue problem is solved by cash diffs going higher, which then maintains a level of TD25 freight that, you don't need that 2025 to go up, or you cannot, because the cash diffs have done the job, or the freight. No, is that still the case, or can you really separate?
That can still be the case.
Okay.
It's what we're saying, though, is TD25 is too cheap. So if it were to go back towards the average of where it's been in similar periods, it should move higher. Of course, cash diffs can absorb it, but we're saying that there's definitely room for TD25 to move higher. Yeah,
for sure. The one does not cancel the other. You can have both. For sure.
Similar with the CPP freight and our margins. If freight could move higher, but MOPAG MOPJ could absorb the rest in regards to an ARB.
Fascinating. And this is something you've been working on, I understand, with John. When are we launching this?
Yep, been working on it with John Coleman. He is launching the crude signals dashboard this summer, and then we are basically going to tweak that into what I've been describing here. So we're taking his work on the crude signals, tweaking it slightly to change the perspective from a crude trader into it being more actionable for a DPP trader.
Well, that's exciting. Well, staying with you, let's move on to, we've been talking about macro and all that, but let's go into a rapid fire update on the different verticals. Staying with you on CPP, maybe?
Yeah, so we spoke a little bit already about the AG, the MRs, and the LRs, but I just wanted to highlight a couple more things. So going into May, especially on the LRs and a little bit less on the MRs, tonnage was quite long. And in that first week of May, both the naphtha ARBs for LR econs and jet ARBs for LR econs opened. And what we quickly saw was over that first week, tonnage was absorbed quite rapidly. And over the following few days, we then saw world scale jump 30 or 40 points. And this is great. But what we've seen now for both the naphtha ARBs and the jet ARBs in the LR market, that has now shut the naphtha ARBs fully. So one of the big pillars of demand out of the AG for LRs is now shut. And those jet ARB margins, again, because of the rally in LR freight, are now basically neutral. So I just wanted to highlight that, yes, we've seen a great rally, but it's looking like it's starting to top out just because freight has moved so much so quickly over the last couple of weeks that the rest of the components of the ARBs have not been able to move enough to keep the party going. So I would just trade cautiously in the TC5 market. And then also on the MRs, we've seen a similar picture on jet. The MR econs shut first. And now that LR1 econs are moving towards neutral. And with the rally in TC17, it's also starting to put some pressure on the mainstay product ARBs into Africa. So just when you're looking at fixing a vessel or trading TC5 or TC17 going into next week, I would just trade a bit cautiously because the impact of the rally is starting to decrease your ARB margins.
Okay, well, that's very clear. Moving on to gasoline. Neil, June, who's taking over here?
I guess I'll take over. I guess the plan is to sort of rapid fire go through the rest of the verticals when we don't have the rest of the team on. But I guess just to highlight the key changes that we've seen, right? Let's say in gasoline, so we're still, I think the view is that we're relatively neutral to bearish on ARA and EBOB spreads. So even though they're already weak, and there's kind of three things that go into that. The first is the weakening in the Singapore market, which we've already basically discussed. And in our tools, that means that there's basically now parity between ARA and Singapore in a few of the kind of important export locations like Nigeria and Ecuador. So relatively bearish ARA from that perspective. And the other thing is that the Houston market's gotten relatively cheap with respect to export markets in basically LATAM, which ARA is competing with. So from that perspective, we're kind of bearish on ARA. The other thing is that we've still got wide open E10 blending margins. And we have the feeling that that is also dragging on sort of June, July EBOB spreads. And, it kind of makes sense to us with respect to refineries are returning, Dangote is returning, and we have chewed through a bit of inventory in ARA, but not all that much over the last few weeks to months. So for us, it still looks relatively poor from an ARA perspective. The one thing just to pick up on is the prompt arb is open for blenders, and typically that doesn't last very long, if I'm correct in that, Felipe. It's relatively bearish for the prompt TA arb, and we think it's rather a push from ARA than it is a pull from pad 1, so to speak. Do you have anything in terms of the TC2 for that, Michael?
Yeah, just briefly, it's had a small impact, this push. Tonnage has been long for most of May, but over the last week or so, we've finally seen more fixtures, and I've seen a few more gasoline fixtures, and tonnage now is below the trailing average, so we should see a little bump in TC2, but I kind of see it as short-lived.
Okay, sort of going in the same direction, I guess. And then on distillate, let's say the key things we saw in distillate is also a rapid weakening in east-west, so it's sort of mirroring the gasoline market in a way, and it sort of makes sense to us with respect to what ARBs have looked like over the last 6 weeks. So everything's been pointing east from the swing barrels, and turnarounds are ending in Asia as well, essentially, or they've already peaked. So the Singapore market looks a lot weaker, and eventually that's going to point some of these swing barrels west, but it's going to take 6 weeks before you actually see that in terms of landings, vessel landings. And the other thing is the HOGO is still extremely strong, so it's basically keeping the Gulf Coast MR to Europe closed, and to a certain extent it makes sense. Pad 1 stocks are critically low, I would say, still. Pad 2 is also really low. Pad 3, not so much in terms of stocks, but it's basically a Pad 1, Pad 2 story. And I guess the question is, it's kind of bullish short term for Europe with respect to TA, basically flow. But I guess the question is, we probably turn a corner soon on US stocks with respect to seasonality and also high runs. So I'm not expecting this sort of critical tightness in Pad 1 and Pad 2 to last very much longer. Does that make sense for you, Michael, TC14?
Yeah. Generally in line.
Okay, and the last two. So let's do fuel oil. The one thing that's come from Hua, our esteemed fuel oil colleague, he's short June, July spreads on 0.5, Singapore 0.5. And the thing is that the blender margins in our tool have been wide open for a long time, for May and June, and really very open. So, for example, for the first time since we launched the tool, actually gas oil is breaking even into the VLSFO blend as a component, which is very rare and is not likely to last. And so that's for the kind of June. And then when we're looking forward into July, the feedstock costs are actually rising quite rapidly. So Australian heavy sweet crudes are rising, Dangote, LSSR prices are rising. And so the idea is that the June component is going to weaken and July needs to strengthen because the forward feedstock costs are rising for the VLSFO blend. So we're short on June, July, very short term. And the last thing is the HSFO market. We've been trying to ask around, haven't we, June, what is causing this crazy strength? And I guess it's also puzzling a lot of our clients, a lot of our contacts, but we're still in an extremely strong HSFO market. And the two things that we note of late was Egyptian buying was relatively strong, and so is the demand numbers from Jody. And there's also been quite a bit of, the sort of crude burn numbers in the Middle East, even for late Q1, are actually stronger than we anticipated. So it looks like there's also crude and fuel oil burn, if you like, is fairly strong so far. So from a certain perspective, it seems justified. Is that fair, June? It's just an extremely strong level.
Yeah, we had the fuel oil drinks last week with many fuel oil traders here in Singapore. Nobody could give definite reason why as well, why the levels are so strong as what we see today.
It will normalize at some stage, just the timing becomes very difficult.
I think it's been like 4 weeks now.
Yeah.
Okay, well, I think that's it for today. Thank you very much, guys, and I'll see you next week.
Thanks,
Thank
everybody.
you very much.
Thanks, Felipe.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.